BloombergQuint. We got the second quarter GDP data coming in, GDP growth at 8.4%, slightly higher than the consensus estimate, GVA growth at 8.5%. Now, the numbers continue to be fairly noisy. There are base effects. Some people are looking at them sequentially, some year on year, some seasonally adjusted, helping us understand what's the message behind these numbers. DK Joshi, Chief Economist at Crisil, and Rahul Bajoria, Chief India Economist at Barclays. Thank you both so much for taking the time to speak to us here on BloombergQuint. Mr. Joshi, I'll start with you, sir. We'll get into the individual numbers in a minute, but what's the big takeaway from the numbers as you see it?
Well, the one big takeaway is that there was no surprise. I mean, in the sense that it was almost a consensus based on the high frequency data that despite the hiccups to the economy from inflation, high commodity prices, supply side issues, I think the GDP was still, or the economic activity was moving up. And then I think this was permitted by, of course, COVID being under control and service sector taking up some of the slack as a result, which we saw appear in manufacturing. And then finally, I think the global environment has been quite supportive. I mean, if you look at the demand side of GDP, I think what stands out is the exports as a percentage of GDP. Phenomenal growth, I think, much higher than 2021. And in the first half, I think the ratio, the exports to GDP is something like 23.5. And in FY20, it was around 19.4. So very significant push has come from the trade. I think very quick second takeaway would be that I think the momentum in investments is somewhat picking up, I mean, compared to private consumption. So that's a good thing and a worry at the same time, because you need higher capacity utilization, and that comes from more private consumption. But the investment picking up is, I think, in a way, there is an exogenous element to it. Government is kind of pushing it. So that is why the momentum in investments is somewhat better. I think investment to GDP ratio is going up, whereas private consumption to GDP ratio is actually constantly coming down since 2019-20.
And we'll delve into that in greater detail. Rahul, your key takeaways first.
Yeah, no, I think I'd agree with what Dr. Joshi said. I think in some sense, this was a number which was in line with consensus. But I would say that, the GVA number did surprise materially on the upside, coming in almost 100 basis points above what the Bloomberg consensus was showing. I would say that, this basically reflects that, activity levels have recovered probably faster than, what was being anticipated, say 6 months or 4 or 5 months back, when we were coming out of the second wave. And clearly there's been, further pickup in momentum, as is evident from the high frequency data available for October and November. So I think the overall signs for the economic recovery remains fairly strong. What needs to be seen, obviously, is, with the new variant, possibly being an issue, and possible signs of, some fatigue in consumption, coming in after this big increase that we have seen in the festive cycle, I think will be slight question marks. But overall, the recovery seems to be on a fairly strong footing as far as, when we look at the fiscal space is concerned, when we look at, what is the aggregate savings in the system is concerned, or even the wealth effects, which continue to remain very large, at least at a macro level.
Joshi sir, so this is just sort of a journalist question. Are you paying any attention to the fact that the activity levels are back to what they were pre-COVID, or are you now more worried about where they are compared to what the trend would have been? I think you've been pointing out in reports that the gap is quite wide and will remain so for a while if you market to trend growth.
I think for the overall GDP, we are, of course, I think looking at that, because that will tell you whether you are erasing the permanent losses or not. But I think if you look within the components of GDP, some of them have touched the trend. One of them is clearly, exports is shooting above the trend. Second, I think the investments do, if the momentum continues, I think they might be able to the permanent loss there would be less than the overall GDP. That's what I'm trying to say. I think my worry is, on the contribution of consumption. Consumption as a percentage of GDP falling is not a good sign. And I think it is partly reflecting the income dynamics that are at play. I think the richer people getting richer doesn't really push consumption up. I mean, it has to percolate down for private consumption to improve in a sustainable manner, so to say. And I think that to me is one concern. I mean, which seem to be playing out. And I think the government still has the resources. I mean, which is a positive thing. I mean, which Rahul was also pointing out. If you look at the revenue collections of the central government, they've already in the first 6 months they've already covered about 60% of what they're targeted, but their expenditures are below 50%. So they are holding these as the cash balances with the RBI probably. So I think so that needs so there is scope for spending. I mean, and I think it's good to have a buffer. And I think if Omicron proves to be a troublesome strain, then I think that buffer will come into play.
Rahul, what's your thought on the consumption data? Apart from what we're seeing in GDP, I think today there was data from Nielsen on the September quarter, and that was clearly showing that rural consumption has been weak. So clearly there is some pain emerging either from another reason on the rural side, or as Mr. Joshi was saying, from the income effect at the the bottom and the middle end of the pyramid.
Yeah, so I think, obviously we only get GDP data from two aspects, by expenditure and by industry. We don't get to see it by sources of income, right? And yes. From that perspective, the dislocations that are there, say within the corporate sector, within the public sector, and within the households, is clearly kind of playing through some of the expenditure data. So the weakness in, say, employment conditions, that is very evident both from survey data, what CMI has been providing, what the PMI is indicating, that wages have not recovered, employment probably is still below where we were pre-pandemic. And so from that perspective, consumption being weak is not a major surprise. I think in level terms it is probably going to remain so. Now obviously for India, given the bulk of consumption, at least at a distributional level, is fairly necessary, and so discretionary consumption is where we are seeing some momentum. I think you will see some improvement, but some of the distributional aspect challenges are going to remain. What is also possibly interesting, and this is where I think what Dr. Joshi was saying comes into play, is that for private investment to pick up, right, and that probably adds at the margin to growth rates, right? When you think about contributions, we will need corporate profitability and corporate capacity to invest being high. Right. So with no credit growth, it is a concern. And I think that is something policymakers are looking at very closely. But at least from balance sheet standpoint, I think with the deleveraging cycle, probably somewhat behind us, the capacity to invest has gone up, but, intention to investment or invest is probably not where we really want it to be. But, if the recovery continues, maybe we'll get there sometime in the next 6 to 12 months.
Coming to that in a minute, Mr. Joshi, the festive season, for instance, all the anecdotal indicators that one tracks, sales, indicators from these e-commerce companies, etc., seem to suggest that there is consumption activity, or strength in consumption activity on the ground in Q3. Are we just reading too much into that, and we probably will see a wildly different picture, or did something actually change in Q3 to your mind?
Well, I think what changed was that the services was getting a momentum. So I think services, particularly contact-based services, 2/3 of them are in urban areas. So I think something that was really taking a beating, and I think there was literally no support for urban poor. I think that saw a change, I think, in the third quarter, because the services started picking up. I mean, the schools or many other activities started opening up. So so it spilled over to, I think, so that kind of also supported consumption, I would say. But I think the issue is there is a base effect there. There is and how long it's going to continue is an issue. Now, if I look at the consumption, there are two trends emerging. I mean, one is that as the labor-intensive services in the urban areas pick up, that's going to be income supportive. It will augment the income. And I think if the fuel inflation does come down, I think the government has done a few things to reduce it. I think that will also be consumption supportive. But what is, I think, worrying is that the input costs are being passed on to the end consumer. And that everybody knows, I think, in an environment where incomes are not rising that much, the rise in prices does hit consumption. And I think so that, I think, is, and that there is no sign of that abating as of now. I mean, the input costs every day, I mean, whether it is FMCG category or it is the other durable category, I think they are, I think there is a clear pass through which is happening. And this also was visible in the RBI survey, I think, which they had in the last monetary policy report. They came out with that. I think it's across the board. It's not just limited to manufacturing. It's in services, it is in manufacturing, and it's also in infrastructure. I think that also means that cost of building infrastructure are also going up. So there will be cost overruns. I think this price dynamics is a little worrying to me, and I think it definitely is not positive for consumption. And I think on the rural side, sorry, I think just to add to it, I mean, on the rural side, the food inflation in general is low. So I think the delta that I think the rural economy got from higher food inflation, which means higher prices, some of it passes on to the farmers. I think that part is a little weaker this year.
Okay. Actually, I'll pick up on that because I think, did I see it right, Rahul, that the nominal growth in agriculture has actually come down. So maybe that's one of the factors playing into rural consumption. But on the other aspects of the expenditure trends, gross fixed capital formation, government final consumption expenditure, those are in line with what you would have anticipated?
Yeah, I would say they're broadly in line, at least with the high frequency data, that we were seeing. Now, there is consolidation from a rate of growth perspective, but I think the key challenge will really be to, sustain them at similar growth rates, going forward, because clearly the base effects will, start to wash out over the next 6 months. And so the levels may start also possibly stagnating. And I think that should be a marginal concern. The only one aspect, I guess, which can work as a silver lining is that, we do think that, the balance sheets have become healthier. And if this momentum in exports, remains relatively robust, as Mr. Joshi was pointing out, we could see, quite a bit of ability to invest kind of being fructified, and actual investments kind of pick up at the margin. So I think that could be a bit of a supportive factor. I do think that consumption overall is going to, probably underperform at the margin because, the labor markets are going to lag in this particular recovery because, the first point of impact is going to be the contact services, right? So that innate, whether it is self, fulfilling or it is something that's enforced by policy, the impact on the contact services is probably going to continue to have a lingering impact as far as the effects of any new health crisis that may kind of throw up.
Mr. Joshi, also on the sectoral side, if I can get a thought. So agriculture, the real growth was relatively strong or stronger than expected at 4.5?
Yeah, stronger than expected. I think there was some fear that the monsoon could have some, I think, the rains probably could play a spoil sport, but I think doesn't look like there was any such impact. And I think this is a very, very strong growth. I think we need to look at what is causing it. I think we will get that data not immediately, but I think whether it is the fruits and vegetables category that has led to that surge, or it is the food grains, or so what is the driver of that? I think that has implications for rural economy or rural consumption as well. So agriculture, I think, it has been stellar. It's not over a weak base. I think I think it's over a very strong base. So I think agriculture has been a big savior for India. And I think despite the food inflation remaining high last year, I think this year it has come down, which is very different from what the trends that we see globally. Globally, food inflation is inching up. I'm discounting for what's happening to vegetables right now, which will obviously climb down in a few quarters.
Okay. Rahul, your thoughts on agriculture, but also industry is looking okay, right? And services recovering perhaps is the best we can say.
Yeah, I think on the agriculture side, we clearly are seeing reasonably good momentum, and that is possibly a function of also the fact that prices were high last year, right? So there's a little bit of an added incentive that kind of comes in because the level of prices are elevated, even though the rate of inflation has slowed down at the margin. But I think overall, the contribution of industry could have been a lot better. I think there are clear signs that in certain specific areas like automobile production, supply bottlenecks, particularly shortages of semiconductors, are playing a part in sort of depressing production levels. So even if it looks like consumption is weak, it partly may not be just a function of, that there's demand is weak. It's probably also the supply not being adequate enough, so the wait times, the lead times for a lot of deliveries have kind of played out. And this may, kind of pay back later in 2022 as, supply constraints ease. At the same time, with the services, the way the whole discretionary services part has recovered, the ability to consume, the willingness to consume is there. I think, the core question is that if we do have another round of disruptions, is that a demand shock or a supply shock? I would say, that it's largely going to be a supply issue, right? That it might sort of break the momentum, but it is not going to completely stall or reverse the recovery that, we are kind of undergoing at the moment.
Just now coming around to the big picture back, Mr. Joshi. So, we've discussed consumption at length. So from here on, the drivers of growth would be exports if they remain strong, and to a considerable extent, government spending. I mean, we saw the fiscal data also come in today. There's certainly room to spend. I don't know whether the states are spending as much as they can or not, but certainly the center, one should expect them to step up spending.
Yeah, I think the center is ahead of the states in meeting their annual targets, so to say. I think they are moving faster towards that. I think, and the momentum in investment spending for the center is also faster than of the states. And I think the reason is obvious. I mean, the center gained much more in terms of revenues. I mean, because out of taxing the oil and so on and so forth. So they gained disproportionately. So they had more ability to spend. The worry is that they're not spending as much as they possibly can. I mean, so that I think that needs to reverse. And I think, as I said, it can act as a buffer during the rest of the only 4 months are left now. So I think for the rest of the fiscal, I think government spending can be stepped up. And I think the focus is very clear. I mean, if you look at government consumption expenditure, it's fallen by 14% year on year. Yeah. Whereas it's not the same is not true of as far as investments are concerned. Investments are moving in different directions. So the tilt is right of the spending. I think that spending towards areas which have higher multiplier effects, I mean, which is infrastructure. I think government still has a very critical role to play. And I just also wanted to highlight one thing. I think when we began the year, I think we always have a forecast for corporates. I mean, how much the volumes will grow, how much the top lines will grow. I think the top lines have not been impacted that much, but I think the volume has been crunched. I mean, so the volume, because the prices have kind of pushed the top line up. So the top line impact is not that much, but I think the volume impact is much. So, and what GDP reflects is the volume impact. So that's why your manufacturing real growth is only 5.5%. Probably nominal would be much higher. So the top line nominal top line is still strong. That's why you're getting nominal growth so high. I mean, much higher than you expected. So
no, absolutely, nominal growth is quite strong, Rahul. On this government spending side, what's your sense of what the issue is? Is it a capacity issue, or are they just fearful that they will not get those non-tax revenues, particularly from divestment, and they don't want to miss their target? What is your sense of what's going on this expenditure side there?
Yeah, so I think it's partly a combination of capacity to spend and this reluctance to really front load spending. I think it's only in the last 2-3 months, that the confidence around the recovery has increased very materially within the policy circles, and you see that being reflected in the tax collections. So we have seen an effort. I would say there's been a front loading of grants, and also the GST compensation cess, which is going to be lower than what has already been paid out. So the government is trying to basically give more funding to states, to try and increase spending. But again, it does take a while before you can really restart projects, or you look to kind of bid out. So I think again, it is a matter of time. We will see some of these numbers kind of feed through the GDP data. It's also quite likely that we will see some of the subsidies which are there in the system, transfers which are there in the system, they will also start to fall off. So very mechanically within the GDP and the GVA, we will see an impact, and you should see GDP numbers being supported at the margin because of that factor as well. So I think it will kind of start showing up, but at the moment, clearly there's a bit of a gap between the resources which are available and the capacity to spend, which is probably not the same, and it has been impacted over the last couple of years given the focus on the pandemic.
Last couple of questions. So, Mr. Joshi, we've got a policy coming up. GDP numbers are more or less going as per plan. I don't know what your full year estimates are. If the RBI is 9.5, is not looking like it's due for revision, and inflation is, headline number is not showing anything, but it seems to be all around. Do you think you'll see a slightly more or slightly less dovish MPC, and will it start at least unwinding the sort of emergency accommodation?
I doubt. I mean, I would see the December policy as a replica of the policy that we saw in October. And the reason is that I think this is clearly an uncertain environment, and there are discontinuities. So the past momentum that we are seeing, its predictive efficacy is very low. I mean, you can't extrapolate it. I mean, so and then at this juncture, all said and done, there is a big uncertainty from Omicron. And the RBI will take up, and the uncertainty will not go away by the time the policy is going to come out. So they will have to take cognizance of it, and so they'll try to err on the side of caution. I mean, if I may, I mean, so basically, I think they will keep the policy as it is. I mean, as of for now, and I think this is really. I mean, we were expecting that some normalization will begin, but I would not take this new variant as something you can ignore. I mean, and particularly from the policymaker side. So this will actually have an overwhelming influence on the central bank decision.
Rahul, they won't even sort of change their mood on reverse repo, which is emergency accommodation, as many of you have pointed out.
Yeah, so I do think there will be a 20-25 basis point hike in the reverse repo, provided that over the next 7 days, we don't get a very negative headline around Omicron, basically saying that vaccines are not useful enough, against this particular variant, because I don't sense that, the variant's impact is going to get factored into the base case, right? And RBI will have to think about what is the base case. And so far, the recovery cycle in India looks to be pretty strong. If anything, we reckon that RBI probably will be seeing upside risks on the 9.5% GDP number, even though fuel taxes have been cut. It's unlikely that their inflation forecasts are going to be materially lower. So the balance of risk is for them to continue, in our mind, with their normalization cycle. So with that, I would think that, they can continue to go ahead and raise the reverse repo, but there's no need to, go in a one-shot move. I think they can possibly split it up. But yes, I don't necessarily see them paying a lot of attention to, or unless there is a very negative headline, there's no need to necessarily deviate a lot from the normalization process which began in October itself.
Fair enough. I'll leave it at that. Mr. Joshi, Rahul, thank you so much for joining us here on BloombergQuint. Very, very kind of you to speak to us. And thanks for watching BloombergQuint.
Thank you.